We want to stay in the world of finance right now, and particularly in the world of private credit. Growing demand for private credit in an environment of higher for longer interest rates. Our next guest says, stay flexible. That's going to be needed so that healthy businesses can grow. Chris Wright is joining us right now. He's the head of private markets at Crescent Capital Group. Also joining in on the conversation today is our very own Shanali Basak. Chris, great to have you here on set.
Great, thanks for having me.
Let's start with the rate environment here. I mean, you've been watching, of course, what the Fed has been doing. 525 basis points fed into the system. I'm sure that in addition to raising the hurdle rate, has also sort of made the idea of valuation maybe a little bit more complicated.
Yeah, no, absolutely. Look, the markets are certainly in a transition, right? Whether it be the equity markets and for M&A, whether it be the credit markets and how we reset those. And so we have been monitoring it very closely. We have been a beneficiary of the higher for longer market. We've seen a slowdown in the markets as a result, the M&A market in particular, but private credit has certainly become, and we've had to become more flexible to meet the demands of the higher rate environment that we're in.
You think about this conversation we've been just having, this idea that Goldman is selling the Green Sky business to 6th Street. This is a consumer business. It lends the question, do you think that a lot of your rivals are starting to get into the areas of the market that are more economically sensitive that could see more hiccups ahead?
Yes. So I certainly think we have retrenched actually to less cyclical businesses in this uncertain environment. And so when you look at what private credit is doing, they're focusing on service-related businesses, resilient business models, highly cash generative. Certainly the consumer has been strong. And so it's really this kind of flexible capital that I think is going to meet the market demand in this transitional period.
But are there things you wouldn't touch given where we are in the economy right now?
Yeah, certainly you're staying away from cyclical. When we're looking at opportunities, we're generally the bar to do things in the industrial space, in manufacturing, in retail, in cyclical businesses. The bar is much higher right now, given the uncertainty that we're seeing in the forward-looking views.
And Chris, just to zoom out a little bit, in every conversation about the private markets, I always think about what you can get in the public markets right now. For example, if you look at areas of the junk bond market, you can get high single-digit returns without a lockup period. And when you think about that, what is the pitch to prospective investors to put their money in the private markets?
Sure. I mean, that's a great question. What I would say is right now we can get senior debt in the private markets at 12% with less volatility, greater due diligence, and fewer participants in that. And so we can control our destiny. So higher yield, greater certainty, less volatility, and greater control.
So, Chris, when we talk about this idea of dealing with existing deals that you already have sort of done, but also bringing new deals into the pipeline here, give us a sense here of how that can be structured in a way that I guess appeases, LPs already, and maybe even gets other folks into the fold. Yeah, look, owners and sponsors of business right now are in this transition period, and they're willing to trade rate and flexibility for equity, right? And so we can come in with flexible capital and provide greater runway for companies to make it through the volatile period that we're in. In exchange, we get paid very handsomely. I am curious, though, but what's the runway for that? Because, I mean, at some point, I mean, if this period that we're in does prove to be near the end, great, but what happens if this does get extended for a much longer period of time? If you look at the high yield market in the U.S., the high yield market, the loan market, and private credit capital in the ground, it's about $4 trillion. A large percentage of that has been in the ground, and it was put in the ground at a lower rate environment. It's going to take a period of time for that to reset. When you look at the loan and bond market, about 22% of it is going to mature in the next 3 years. And so there is going to be a reset with the dollars that are in the ground. It's going to translate into higher yields for lenders, better terms for lenders. And if we stay in a higher for longer environment, which I think the markets are all signaling, we've certainly seen that.
So you're looking at 5% on the 2-year, but realistically for a risky borrower, what are they paying next year as they refinance?
Yeah, so there is going to be a reset. When you look at what this year, the refinancing in the bond market's been about 100 to 300 basis points. Now, what happened in the refinancings this year is the best companies are getting refinanced. What we haven't seen is the lowest rated companies get refinanced. That is going to be a big reset. That's going to be a 400 to 600 basis point reset that we're going to see. And it's going to come into the hands of private credit because we have the flexibility and can provide that type of capital.
Chris, great conversation. Really appreciate your time. Our thanks to Chris Wright, head of private markets at Crescent Capital Group and Bloomberg's own Shonali Bassick.